The Rainmaker Multiplier on-demand series is brought to you by Clarity to Prosperity, a financial training, coaching, and IP development organization led by financial advisors, coaches, and business leaders committed to taking a holistic approach to advising. To learn more about our organization and upcoming training opportunities for financial professionals, visit claritytoprosperity.com.
Welcome to the Rainmaker Multiplier. I'm excited for this session because this is something I'm very passionate about, and I know my partner that I asked to join us for this, Dave Alison, is as well. And we're going to talk about optimizing a tax practice or even just tax planning in general to grow your financial services business. So welcome, Dave. Thanks for joining us.
Yeah, thanks for having me today.
There's three components of what we're going to talk about today, and these are actually programs that we offer at Clarity to Prosperity. But we want to talk to you about them and the benefits of you're going to receive, regardless of what you do or how you go about doing it on your own or working with an organization like us. We want to talk to you about these three different components of taxes in general. One is building your own tax practice from the ground up. So tax preparation services where you own it. The second concept is more of renting it, right? Where you can align with an accounting or CPA firm that's doing tax preparation and leveraging their tax clients to turn into financial clients for your firm. And then the third component is the tax management journey. It's really how to maximize cash flow by financial and tax planning strategies kind of coupled together.
And, you know, it's interesting, Jason, it's come full circle. I mean, how you and I met back in, I think it was 2008, is I was working at an organization that helped financial advisors build a tax practice, and you were looking to build a tax practice in the JL Smith Group. We met at $1 Million Roundtable, top of the table, and it's just been incredible to see what you've been able to do at the JL Smith Group in terms of building a tax practice, along with the coordination of a lot of other members in the mastermind group who also have tax practices. I mean, to see how far this tax business model has come is amazing. So talk a little bit about the tax practice builder and maybe share a little bit about what you've been able to do at the JL Smith Group with it.
Right. Well, one of the biggest things for me too in building a tax practice, so tax preparation firms, is I didn't know anything about tax planning really 10 years ago, to be honest with you. And so what happened was, though, is I delivered all the tax returns of the people who had money. And so that was part of building the tax practice. Was I wanted them to come in and do the data entry and the tax preparation with the tax preparer. But when they come back in to pick up their tax return, that I sit down with them to deliver the tax return. And then inevitably, I learned a lot about taxes, right? Q&A, answering questions, delivering the return, going line by line. I learned to identify all kinds of tax planning opportunities that happen within a tax return or that I didn't really know about before. And that's more what we'll talk about later on. But let's talk a little bit about the benefits of owning a tax practice. So in doing that first, though, let's kind of look at big picture of, the kind of steps, right, or the different components of owning a tax practice. So as you see up here, we kind of have it broken down. They're in 8 different modules within our online university e-learning course and what we teach our live trainings as well. So just to give you an overview, if you're thinking about building a tax practice, or maybe you already have one, you're familiar with some of this, but what we've done is, in steps 1 and 2, it's really about kind of getting all the stuff in order and finding the right people to come in and help you do the tax preparation. And so, I mean, there's EFIN numbers and kind of just the tax preparation software you need. You need to have, the ads and the resumes and how to interview, what questions to ask. I mean, really, like if you're going out there trying to find a tax preparation person, don't try to go out there and find a CPA. They have a totally different skill set than what you need. You might find a unicorn CPA that can do what you're looking to do, but more often you're looking for somebody who's worked at like an H&R Block or a Liberty Tax, or maybe they're an enrolled agent, or they do a bunch of taxes already and have the capacity to do a bunch more. Maybe they own their own little tax practice where they work out of their house. You're looking for volume. You're looking for somebody who does a lot of personal returns, busts a lot of them out already, 100, 200, 300 a year. And because people, believe it or not, have the capacity to do 5, 6, 800 returns a year. Like I was just talking to Don the other day. His top tax preparer does 800 a year. His second does 600 a year.
Incredible.
It is
about having a good business and infrastructure around them as you grow that big.
Yep, there's no doubt about it. So that's the kind of the first two is getting the right technology and paperwork to keep yourself out of trouble. Get your EFIN number, get the right people in place, etc. And then the next two components are really about how are you going to market it, right? And I mean, how are you going to get the people in the door? What I would suggest to you is don't invite your existing clients the first year, right? Go out there and drop some mailers, or if you have relationships with local companies or municipalities where you can drum up some business there, do that first, because really ideally you're looking for somewhere between like 60 and 120 your first year, because there's internal processes that you want to get put in place, and there's kinks you're going to inevitably have to work out. We did about 100 returns our first year. It was a perfect number to get a foundation built. Not saying there's a lot of learning curves, and so you want to kind of do those, and you don't want to do them especially on kind of like your A-list clients, right? Don't practice on them. Do that on new prospective people coming in the door. So that's what it's really all about. And it's also about, again, managing the volume of new people coming through in a short period of time like that. And so, how to set the appointment. I mean, we have scripts, we have, calendar maintenance, all those kind of things that you're going to want to do and have in place for a preparation to move on to the next kind of couple steps, which are really what happens, what's the experience when they come into your office, what forms do they need to sign. I mean, we do a drink menu. We have a director of first impressions that makes sure she greets them. She has a kind of script that she goes through. And then ultimately, when they sit down with the preparer, there's a script that the preparer does to open it up, to explain to them what the process is, that they're not going to get their taxes done that day at the end of that appointment. They're going to come in, they're going to drop off the information. The preparer is going to ask questions, input data, and if they really want to get a ballpark, they can give them that then. But there's a quality control and a second set of eyes that happens before we end up going to the next phase, where they come back in and they pick up the appointment and they sit down with the financial advisor to pick up the tax return. And so that's really what happens in 7, is really delivering the tax return, reviewing it, which you're going to want to get real familiar with reviewing a tax return. For example, we have an online course, we have a live course Dave will talk about, to really familiarize yourself with how to read a tax return, how to spot the tax planning opportunities that you can spot that correlate directly with financial planning. And then ultimately, when you're building up this base of tax clients, regardless if you own the tax practice or you're renting the tax practice, you need to figure out how to do the ongoing marketing to convert those tax clients into financial services clients. But what I love about my tax practice is that it is a profitable lead generation solution. At JL Smith Group, we'll bring in right around 60 million of new client assets this year, of assets under advisement, right? New assets in the door we'll bring in this year in 2019. And so when we look at that 60 million bucks, about a third of it will be from tax clients. And so you really, I mean, for me, what I love about it, and you can see it up on the screen, I mean, when we look back at our tax season, 2017, we did 1,700, 18, 1,900, 2019, this year, we did 2,100, a little over 2,100 tax returns. Now, we're marketing to savers. We're marketing to people who worked hard, saved up money, not high net worth entrepreneur business owners. That's not our segment with the tax practice. With the tax practice, we're looking for pre-retirees and retirees 50 to 75 years old that went out there and worked hard and saved up some good money. And they're mass affluent, right? They're the mass affluent segment. It's the middle class millionaires. Most of them made their money by saving. And these are the people, hey, man, a lot of them, they cut coupons, they watch their spending, they make smart decisions. That's what they do. So they love the idea of a nice discounted tax preparation service. It's attractive to them. So we charge 99 bucks for new people coming in the door as a rate to get them in. And after that, I think we're at 119 or 129. And so, after the first year. So as you see up on the board, the total income isn't anything to brag about. It's $236,000 because once we pay all our expenses, we net out just from tax preparation about $73,000 bucks. And you're probably saying, Jason, is that really worth it? But, to do 2,000 tax returns. But here's the thing. We have a tax practice manager, runs it from nuts to bolts. All we do as the owners of the firm, is myself as the owner of the firm, is I sit down with people who have money, right? I mean, that's my only responsibility. But we net 73 grand just on tax preparation. But the key is, it's not about making the 73 grand on tax preparation, profitable lead generation solution. The key is the money we make off the financial services. So we do a presentation on this tax practice twice a year in June and December. So these are the numbers we updated for June. And so as of May 28th, right, this is just from the tax practice of this year in 2019. We had brought in 2.1 million of a new annuity premium. So this is just at the half year point. Almost 3 million of new AUM. And then you can see what annuity, commissions, and on. But look, at the bottom, at the end of the day, we brought in $252,000 year to date in just less than 6 months, only from just the tax clients. And now the second half of the year is always dramatically bigger than the first half of the year. Because the first half of the year, January, February, March, April, you're very focused on tax season, right? And so you're just starting to build those relationships. It's what happens in May, June, July, and throughout the rest of the year is where the real money's made. So as you can see, we really only had May, right? The rest of it was tax season. And so you'll see that we'll close out this year in the $700,000-800,000 of just off our tax season tax clients.
Well, and I know, Jason, one of the things that's not even factored into that number is the experience that the other clients who are not tax clients per se have. So, for example, I know your office, you do consumer workshops and things of that nature. And so it's another added benefit when somebody comes to a JL Smith Group consumer seminar for financial help, Social Security, or whatever the case might be. They probably find it very attractive that you can also take care of their taxes. So while they necessarily weren't a tax client initially, they've become a financial client because they see it as a big added benefit that you have the ability to do their taxes also.
There's no doubt about it. They all play off each other. Our Medicare clients become tax clients, then become financial clients. Our tax clients end up becoming Medicare clients and then become financial clients. Our Social Security people that are looking to us for Social Security consultations, those presentations come in, like you said, they become tax clients, than financial, or they become financial because they see that we can offer holistic services. So they all really play off of each
And
other.
I bet it's very sticky business then. You don't lose a lot of clients when they're doing all those.
Yeah, I had heard something like that years ago. Like, they're a client when it's one transaction, but they do another line of business. Now they're a customer or something like that. But it is the stickiness is the point.
So I've been showing this for years. I've had the opportunity to help advisors build tax practices since 2006. So we've seen a lot of tax businesses open over the years, and we've seen how they've progressed over the years. And these are some of the numbers that Jason kind of shared, regarding the first year. But if you think about building a tax practice, what you're really building is your own annuity, an annuity for yourself. Think about it. An annuity pays you an income for life. Your tax practice is going to pay you an income for life, not just from the tax preparation fees, which Jason shared aren't the main reason to do it. It's from the assets that you have the potential to convert into wealth management business. And so here's an example. As we mentioned, we target who we do tax preparation marketing for. We're not doing it for everyone out there. We're not having a guy dressed like the Statue of Liberty dance on the street corner waving a sign that says low-cost tax preparation, right? We're target marketing who we're going after. And so let's take an assumption that the average tax client has $250,000 of investable assets that they've saved up. And in a lot of areas, that might be a low average, but let's just take it as an assumption. $250,000 is what the average tax client has. Well, your first year, if you get 100 new tax clients and they each have an average of $250,000, well, you now have a book of $25 million of assets that you have the potential to go after and convert into wealth management. Hey, even if you only got 10% of those that first year, it's still a nice little kick for yourself, right? Fast forward 3 years later. Now your business is up to 300 tax clients, and they have $250,000 on average each. That's $75 million of assets that you have the ability to convert. And go even further, 5 years out, 800, that's $200 million of potential assets under management. You could see you get into, what are you in now? Your 11th or 12th year, Jason? You've got a couple thousand tax clients. Some of them, of course, don't have money, but there's some that are millionaires that are in that base. And certainly to think that on average $250,000 is very realistic. It's a big book of business that the advisors at the JL Smith Group have the ability to cultivate and farm over time. And I think this is a missing gap too, because we speak with a lot of sole practitioners. They want to build a business. They want to bring in additional rainmakers into their firm, but they struggle to do it because they don't even have enough activity for themselves, let alone an associate advisor to help bring them up to a rainmaker status. And as you could see, I mean, imagine 5 years in, you have 800 tax clients. Like, do you meet with all 2,000 of your tax clients, Jason, personally?
Yeah, I don't even meet with 200.
Yeah, you probably don't even meet with 20 of them at this point. Right. I mean, the reality. But you have how many associate advisors in your firm now that can just feed off of that tax base?
Yep, 5 of them. And it keeps them slammed all tax season. And they'll cherry pick, and I'll meet with maybe 20. I mean, that's probably a fair number of the ones that really are big opportunities. And so, I mean, at the end of the day, too, I've become such a better advisor, as I was alluding to earlier. I didn't really know much about taxes, but I was forced into learning a ton. And now, I mean, it's a key differentiator in my local market and competitive advantage is the tax planning services. I mean, you're the trusted advisor when you're taking care of the taxes. Think about how people view their CPAs. The people that take care of their taxes, it's a different kind of relationship that they look at. And when it really gives the big advantage from a holistic planning standpoint, right? I mean, we know it all feeds off each other. Social Security optimization, the financial planning and retirement income planning, and in the wealth management piece, and how to invest your money and what decisions to make and where to draw from in retirement. It really it is what holistic planning is. If you're missing that tax component, you're missing a lot. And by owning a tax practice, you basically default, don't have a choice but to become good at tax planning. It just happens. And they come back every year regardless, because they might not be ready to do financial business the first year. They might not be ready to do business the second year. But ultimately, the majority, by the third, fourth, fifth year, they end up becoming clients. I mean, you just build that relationship over time, and it just happens. And so that's super powerful. And the opportunity to continue to market to them in several different ways, in several different avenues that you can make them more of a customer and not just a client. And just really, and we've all had that happen where a CPA can kill the deal. Their tax person can kind of poo-poo your recommendations. That doesn't happen when you have that control, when when you're owning the tax practice.
Don't get poo-pooed on.
Right. And that segues well, into the own it component is really a lot of the work, 1 through 6, right? But more recently, a year and a half ago, we partnered with another firm about an hour from our office. They're similar size to us, over 2,000 tax clients. And all we're doing is step 7 and 8. So we're working with their tax clients, we did a revenue sharing agreement. We're paying them 20% of the revenue, and ultimately they got licensed and all that good stuff. But we are actively, they give us the whole list of the tax clients. We're marketing to them. We're doing workshops. We're drip marketing. We're doing digital marketing to them, and we're having great success of taking all the things we've learned through the years, Dave, on how to cultivate the relationships of the tax practice you own. It's completely transferable to other tax practices. So if you have no interest whatsoever in owning a tax practice, it doesn't mean that you can't rent one by doing a revenue sharing agreement and ultimately execute on the tax client conversion. Because that's the key, is you can plug and play right in and do tax client conversion strategies, do marketing and point of sale strategies to turn other people's tax clients into your financial clients.
Absolutely. And I found this to be so beneficial. My business is a little bit different than Jason's. We don't have a high volume tax practice like he's doing in his community as a marketing machine and differentiator, but we certainly engage in tax planning and looking for client conversion opportunities from the tax return. And the tax return can be one of your best friends as an advisor. The tax return is hands down one of the best sales tools that exists. The reality of it is that brokers don't look at the client's income tax returns. Heck, a lot of brokers aren't even allowed to because of their compliance departments or the firms that they work for. And the other side of the coin is that most accountants or CPAs are not helping our clients reduce taxes. They're historians. They're looking at what happened in the past, and they're so focused on just getting the return completed that they're not taking the time to look at all of the financial impact and decisions around how that client can better restructure their situation to save into the future.
Yeah, you know what I'll say to people, regardless if they're a tax client or not a tax client, just when I'm talking to people and I'm talking about tax planning and the importance of coupling that with their financial planning, is I'll say there's a big difference between tax preparation and tax planning. They're two completely different things. And the biggest mistake people make is they confuse them as they're all one thing. And they're two completely separate things.
Right. And we're going to talk a little bit later about the tax management journey. Our partner, Professor Worley, in that always says, tax preparation is like going to the mortician, right, at the funeral home. He's going to tell you the cause of death. Tax planning is like going to your primary care doctor for a physical to help get your health on track, right? And they're just completely different things.
Nice.
Yeah, exactly. It takes it a little bit more morbid, but gives it a sense of humor. And we need that when we're talking about taxes, right? So let's talk about the sales opportunities here. We're going to show a couple side-by-side tax returns. This is why it's so important to learn a tax return. Like Jason was saying, if you're not very familiar with taxes, there's little things that we could show you or you can spend the time to learn on your own that could make such a huge difference. We're not talking about you being able to personally do tax preparation. I mean, Jason, could you do a tax return if you had to right now?
No.
No.
I'd struggle.
But you own a tax
I
practice.
could read one really well, but to actually have to data entry it,
So here's the reality of it. You're going to read it. You're going to look for opportunities. Here's an example. This is a 2018 return. The client comes in and you look at their return and you see on line 2B, they have $4,000 of taxable interest, probably coming from CDs or bonds. On line 3B, you're going to see $8,000 of ordinary dividends. And so that's $12,000 of income that's showing up right there in those two boxes. Now, outside of that, you can see they have $30,000 coming from IRA, pensions, or annuities, and $40,000 coming from Social Security, of which $21,300 of that is taxable. And so if I see this on my client appointment or my prospect appointment, I ask a simple question. I say, you know what, Jason, I see that you've got $12,000 of dividend and interest income. Let me ask you something. Are you using that to live off of right now?
No.
No?
No, it's just my investments.
It's just your investments. I'm a little bit confused. I mean, if you're not actually using it to live off of, why are you generating it from your investments and having to pay tax on it each year?
It's just how it works, right?
You know, there's actually more tax efficient ways that you can defer that income, right? And not recognize and realize it. And let me actually show you something, Jason. So on your tax return, based on this scenario of $4,000 of interest income, $8,000 of ordinary dividends, $30,000 coming out of your IRA, and $40,000 of Social Security benefit, you owe about $3,426 of total tax.
Right.
So you write the government a check for about $3,400. Now, if I rerun your tax return, and I just did a what if, showing that just by reallocating some of your investment options, we deferred that taxable interest in ordinary income. You see how there's nothing on the tax return there?
Yeah.
Because we just restructured how you were investing some of that money. Look what your tax liability is now, $1,453. So that $12,000 of income, Jason, that actually has cost you $1,973 of extra avoidable taxation. That's about 16.5% tax rate on that money. And it could be completely avoidable because you're not using it to live off of.
And the key is really, Dave, you think about it, 3,400 to 1,400, that's a 60% reduction in taxes.
Absolutely.
I mean, 60% reduction just by repositioning your assets into an alternative investment vehicle.
Right. So I'm asking you now, Jason, as we're having this meeting, I'd say, you know, based on some things, if I could reduce your taxes by about 60%, would you want to come back in for another appointment and we can explore how you could do that?
Yeah.
Okay.
Sure.
How's next Tuesday look for you, right? I mean, and that's how easy some of this could be. You don't have to be a tax genius to understand the impact of something.
What happens if you kill my spouse, though, Dave?
Well, let's talk about that. Let's kill off her, right? Let's kill Holly here. So the death of the spouse, this is another area to educate. Nobody, no CPAs, no tax preparers are educating the clients on the impact of a death of a spouse. And you know who the only people that really recognize this are? Financial advisors who have been in business long enough to have one of the spouses unfortunately pass away and see the financial ramifications of this. And so here's a concept, legacy planning for the surviving spouse. We have a married couple. They're over age 65. John's Social Security is 20 grand. Sally's Social Security is 10 grand. And they're taking about 30K a year out of their IRA to live off of. So they have $60,000 of income. Well, based on the current tax code, their total federal tax is about $988. They pay very little tax right now because the standard deduction in 2019 for a married couple over age 65 is $27,000, and we know not all Social Security is taxable. But now John has a heart attack and passes away. Sally becomes a single filer over age 65. Now she still has all the same expenses, so she still needs $60,000 a year to live off of. But Jason, what happens to one of the two Social Securities when John passes away?
Yeah, it goes away.
The lower one goes away.
Yeah.
So now she only gets $20K of Social Security. And her husband, John, spent their whole life accumulating and saving in 401Ks and 403Bs. So all they have is qualified money, right? You have plenty of clients like that, I'm sure. So she has to now take $40,000 out of her IRA to live off of to maintain that same $60,000. Look at her federal tax liability, $5,357. That's a 442% tax increase. We call it the death penalty for a retiree. When you lose a spouse, you get penalized under the tax code in a big, big way.
It's astounding.
It is astounding. And here's what it looks like.
Now she's living off $4,000 less, really.
$4,000 less.
And depleting the assets much faster.
You know, and Jason, we talk about this in our tax planning training. A lot of advisors talk about purchasing power, and the thing that can hurt purchasing power is inflation. I would actually argue that rising taxes can hurt purchasing power more than inflation in a lot of cases. And that's like an additional tax to her, right? That just kills her purchasing power. And guess what? It's a merry-go-round, because if she takes more money out of the IRA now, what happens?
Yep,
More tax, more money, more tax, more money, more tax. It's just a merry-go-round. And if you lay these side by side on a tax return, if you show them, you got to make it real for the clients. And so we really like doing a lot of these tax what-if scenarios. Here's an example of the actual 1040. We show them as a married couple. We show $30,000 of Social Security and $30,000 of IRA income, $60,000 of income. And in this case, this was 2018, where the standard deduction was a little bit lower. You can see they owed $1,028 in tax, a little bit higher than the 2019 numbers because the government indexed the standard inflation a little bit more, the standard deduction a little bit more, excuse me.
Right.
Side by side, I kill off one of the two. Now they're single on the tax return, and there's that income. There's that tax, $5,493. What's so powerful, and Jason, I know you guys do this in the JL Smith group all the time, is you make it real for the client by doing it on their tax return, right? Showing them the actual impact, what they would be looking at if it happened to them. $4,465 of lost purchasing power in retirement, in this case, upon the death of the spouse.
Yeah, huge.
So what about opportunities, right? We just experienced the 2017 Tax Cuts and Jobs Act. And what's one of the best things that was created from the Tax Cuts and Jobs Act? One of the best things that was created was this expanded 12% bracket. So many people are missing opportunities by not maximizing that 12% bracket. And guess what? With the IRS tax code, it's a use it or lose it system.
And this is what really motivates them to listen to this type of planning and advice you're sharing right now, Dave, is the previous slides. Like, what happens if you just follow the government's plan and reactively just, boom, look what happens. But look, now let's talk about proactive strategies we can do to diffuse that tax liability.
Absolutely. So here we have clients, Mr. and Mrs. Sample, and they're both 66. Now, currently, Mrs. Sample is retired, and she has he has a pension, Mr. Sample, of $24,000 a year. And then they have some part-time wages, consulting income, $46,000. So they have $70,000 of income right now. Now, that's not showing any other Roth conversions. But what we would do is we would look at the tax return and the brackets and identify that we could actually convert $33,000 of their IRA into a Roth IRA and never leave the 12% bracket. So we're filling up the 12% bracket. We're not leaving any capacity there. So what that basically does is it takes us from 70,000 of total income to 103,000 of total income. Federal tax was 4,830. Now it's 8,790. The additional tax to do the conversion was $3,960. $3,960 divided by 33,000, that additional income, you could see we never left the 12% bracket. Now, Jason, would you rather pay tax when you know it's 12% today, or would you rather kick that liability down the road when we know on December 31st of 2025, the sunsetting provisions are going to happen, and what's going to happen to that 12% bracket? It's going to go back up to that 15% bracket that it was previous to the tax cuts. I don't know, my math is all right, but isn't paying 12% better than paying 15%?
Well, yeah, and isn't 12%, if you were a farmer and the government said to you, you have a choice, do you want to pay tax on your seed or your harvest? Which one are you going to choose?
I'd choose the seed in most cases.
Right, because the seed is lower than the harvest, right? Well, in this case, you can pay the tax on the seed at 12% instead of paying tax on the harvest at potentially 15%.
Absolutely.
I mean,
and even worse, what if your spouse passes away at the time too, and now you're actually in a 20, 22, 24, whatever the rates
22 or 25%.
Right.
Yeah, if it goes up.
If it continues to go up, absolutely. And so here's what that looks like, again, side by side on a tax return. We have $24,000 of that IRA income, that pension income before, and we have $4,830. We convert a little bit more, so we have $57,000 now, and again, $8,790. So you can show them right there on the tax return, and we tried blowing that up a little bit for you. So again, these tax planning strategies could make all the difference. It's all about being a holistic advisor, looking at all the different dimensions of how you could help your client succeed, where most other brokers and a lot of advisors out there, they're just trying to sell a product. They're not looking at all of the pieces of the puzzle. And so what we started to identify is a lot of advisors were coming to us and saying, well, how do we learn tax planning if we want to? How do we start understanding these strategies? And I know, Jason, you in your office, you've been doing these for a while. I've been doing the tax planning for a while as well. And one of the things that we came to is, it was actually last year, about halfway through the year, right around June, I had sat down with a prospect and went through my first appointment, got to the end, quoted them the planning fee based on our planning fee process, and they moved forward. And it was a big win because it was the third client that year that had between 5 million and 10 million of investable assets. I went 3 for 3 on getting them to become a client. And I was at home that night talking to my wife, and I just shared with her, I said, I just feel like I'm on fire, like 3 for 3 with these high net worth clients, pretty good. And she was like, well, what are you doing differently in your first appointment? And I was like, well, I'm going through the normal process of the bucket plan that really Jason pioneered over the last 15 or 20 years, where I'm educating the client on the money cycle. I'm educating the client on the philosophy that we subscribe to, which is the bucket plan, bucketing their money. And then I said, I'm walking up to the dry erase board and I'm sketching these tax planning concepts. And she hands me a piece of paper and she says, well, sketch here what you're sketching. And I kind of drew this like journey on the one piece of paper. And it started with helping the clients understand the order of money, that not all of your money has the same future purchasing power. If you invest $100 in a 401k and it grows to $200 and you go to take that money out, it's not going to have the same purchasing power as if you invested $100 in a Roth account and it grew to $200. And so helping clients understand that. Number two, helping them understand their current brackets and measuring it, because taxes are not intuitive. Some years it makes sense to create more income, i.e. Roth conversions. Some years it actually makes more sense to defer income via deductions. But based on current tax policy and their individual situation, it could change each and every year. Number three is helping our clients avoid marginal tax traps like the Social Security tax torpedo that actually could cause clients to pay a marginal rate of up to 49.95%. I mean, Jason, if you knew you took a withdrawal out of your IRA of $10,000 and you were going to have to turn around and write the government a check for $4,995 of that, would you think twice about taking that withdrawal?
Right. No.
Right? No, especially if you're only in the 12% bracket. Number four is how clients should allocate tax-sensitive assets. What types of investments should they hold in their Roth account? What types should they hold in their post-tax account? And what types should they hold in their pre-tax account? And then ordering how they should take distributions out of those accounts when they retire. Number five is gifting strategies, not only gifting to charity, but intra-family gifting. Number six is analyzing, does it make sense to pay now via creating income, or does it make sense to pay later via deductions? And the five different types of Roth conversions. There's actually five separate types of Roth conversions out there, but nobody's talking about this to clients. Number seven is helping clients manage their dynamic bracket. Tax planning is not a one-time event. We call it tax management, the tax management journey. Get rid of tax planning. Tax management is just like wealth management. Clients are hiring us for an ongoing relationship. And our end goal, thousands and thousands of pages in the IRS tax code, we're using those pages to help our clients maximize income and reduce taxes. And so I sketched it out on a one-page piece of paper, turned it over to our graphic designer, and that's how this visual came about. We want clients to understand that not all money is taxed the same. And when you could bring this level of conversation to your prospects and clients, you're going to win more high net worth cases. And bottom line, even if they're not high net worth, this is just as effective for the mass affluent, the middle class. Sometimes those people actually need this more because a penny saved is a penny earned, and those clients appreciate it.
And really what I'm finding is, by using these different tax management, strategies that we've identified through the years, and now you've done a great job, Dave, of kind of like putting it in a format where we can simply educate, because we have some great tools that are, that was kind of like the big picture that, that we show the funnel and the measuring cup and the different ways to kind of like simplify it. But you totally differentiate yourself from the other tax preparation professionals as well as the other financial people you're competing with. But where this really comes in is when you're working with those people, even when they're not quite to $1 million, it's like you said, it's that mass affluent. They start to really get into those great opportunities to maximize 12% bracket bumping, different things that you can do, blending out income, delaying Social Security so you can do some Roth conversions, harvesting gains at a 0% bracket out of long-term capital gains on non-qualified monies. I mean, there's so many cool things you can do when people actually have money. And that's why it's more in that, getting close to $1 million and above. I mean, you start really attracting those kind of people, which are the clients you really want. And so now you can start charging fees for your advice, because pulling together that holistic Social Security, tax, and retirement income planning and wealth management and insurance kind of all into one comprehensive holistic plan is a big benefit. And, from the advisor standpoint, to be able to have the point of sales tools and just a systematic process that you can deliver of how you're going to bring the tax planning in a simplified way, and that's what we're going to do. What we can do is we can really help you in our training of how to simplify it and show what if scenarios, tax what if, kind of like we did of killing off my wife. You did great. No, I'm just kidding, Dave.
That's right. I mean, here's the reality, Jason. For any CFPs on the call, if you go and read the CFP Board of Standards, it states in the Financial Planning Competency Handbook, a competent financial planner can evaluate multiple years of prior 1040s and supporting documents to inform present tax planning decisions and identify planning opportunities in areas of concern for current and future periods.
And so there you go. And the key is there, it doesn't matter. I'm not a CFP. I know you are. But the bottom line is I'm a badass financial planner. No, I mean, I am a very good financial planner. And the reason I'm a very good financial planner is because I'm doing that, right? CFP board even says you should, or really, if you're a competent planner, you should. But, you know, you don't have to be a CFP. You just, but really, if you want to go to the next level of success, you really need to be doing this.
Absolutely. And we would say, and probably Jason and I both argue, it's not a financial planner. It's anyone holding themselves out as a holistic advisor. And that's what our organization is built around. And we've both seen the client benefits firsthand of delivering proactive tax planning, coordinating between the client's financial plan and their tax plan, giving better investment decisions because you're educated on tax ramifications, giving your prospects and clients a higher likelihood of achieving their goals. They invest and save money so that they have purchasing power at some point later on in life. And last but not least, elimination of avoidable taxes and penalties. Ed Slott says it best, taxes are the single biggest factor that will set people back from their retirement dreams. If you're not focused on taxes, you're not looking at the complete picture for your clients to help eliminate risks. So if any of this resonated with you and you do want to take those steps to learn more about tax planning, we've partnered with Professor Worley, the adjunct professor of taxation at Villanova's Law School and the adjunct professor of wealth management at the College for Financial Planning, to deliver a one-day course on the tax management journey. You'll leave with the confidence and the competency to begin engaging with your clients and prospects on tax planning. Now, if you want to learn more on that, visit c2pevents.com/tax journey. And Jason, talk to them a little bit about what resources are available if they want to learn a little bit more about a tax practice and potentially owning it versus renting it.
Yeah, you got it. I mean, you got a white paper here that's available for you. And we also did a podcast where I interviewed one of the advisors in my personal practice who I brought in really right out of college, and he was doing tax preparation originally and then morphed into a holistic planner, but he ran the tax practice for several years and now is transitioning it over to another person. But he talks about from a firsthand experience standpoint of what it's been like to go from being the tax preparer to the advisor delivering the tax returns, the one running a tax practice, building it from the ground up, and then ultimately our experience of renting, and that's conceptual, of course, but where we did a revenue sharing agreement, as I spoke of earlier with another tax practice, and how that, all the logistics of how we set up that revenue sharing agreement, how we market to their clients, all those type of things. So if you want to hear about those things on the podcast, that podcast is available for download as well.
Well, we appreciate everyone jumping on the webinar today, spending the time. Hopefully you got some powerful nuggets out of this about how you can implement tax preparation or tax planning into your holistic financial planning and wealth management business.
And thanks for joining this month, Dave. Take care. We'll see you on next month.
The Rainmaker Multiplier on-demand series is brought to you by Clarity to Prosperity, a financial training, coaching, and IP development organization led by financial advisors, coaches, and business leaders committed to taking a holistic approach to advising. To learn more about our organization and upcoming training opportunities for financial professionals, visit clarity2prosperity.com.